Assalamualaikum listeners, welcome back to the recording of chapter number 14 exercises. We have already done with the discussion of chapter number 14 content, which was about retained earnings, dividends, and some of the analysis ratios. This chapter, these exercises are in continuation to the chapter number 14. I've chosen some of them which I'm going to discuss with you in today's recording. So Let's start with the first exercise, which is exercise number 14-1. On January 1st, Gulin Corporation had 95,000 shares of no par common stock issued and outstanding. So if it is no par, we should have a stated value, or they should clearly write it no par, no stated value. So the stock has a stated value of $5 per share. During the year, the following occurred. April 1st issued 25,000 additional shares of common stock for $17 per share. June 15 declared a cash dividend of $1 per share to the stockholders of record on June 30th. July 10 paid the $1 cash dividend. December 1st issued 2,000 additional shares of the common stock for $19 per share, and December 15 declared a cash dividend on outstanding shares of $1.2 per share to the common stock to the stockholders of record on December 31st. What we are supposed to do, we are supposed to, number one, prepare the entries to record these transactions, this one, and then how are dividends and dividend payables reported in the financial statement prepared at December 31st. So we need to also show how we're going to report these dividends and dividend payable. So let's start from the first journal entry. Issue 25,000 additional shares of common stock for $17 per share. So company gets cash because of this issuance, and common stock gets credit. And we will also have additional paid in capital, which is paid in capital in excess of stated value. So cash gets debit, 25,000 new shares. 17 is the par value. If you multiply, you get 425,000. Common stock gets credit with the stated value. So 25,000 shares, stated value is 5. So 125,000. 17 is the issue price, 5 is the stated value. So how much extra? $12 each share extra. So 12 multiplied by 25,000, we get 300,000 as additional paid in capital. Then what happened? The company has declaration date declared a cash dividend of $1 per share to the stockholders of record on June 30th. Where are we? We are June 15. Okay, so cash dividend of $1 per share. How many shares we have? Firstly, we need to check. So 95,000 shares were original, then 25,000 more shares were issued. So basically, we have 120,000 common stock and $1 per share. So let's check. Cash dividend gets debit 120,000. Sorry, it's not clear. 120,000 shares we have. How? 95,000 was the opening balance. Then we issue 25,000 more shares on April 1st. 120,000 shares that dividend is only 1 per share. 120,000 gets debit. Dividend payable get credit, which is 120,000. Then what happened on July 10? They paid the cash dividend. So now dividend payable will be removed and cash will get credit. So here dividend payable gets debit and cash gets credit. Then on December 1st, issued 2,000 additional shares of common stock for $19 per share. So cash gets debit, 2,000 additional share, $19 per share, so 38,000. Common stock gets credit with the stated value, so 2,000 shares multiplied by 5, that is 10,000. How much extra you are charging them? You are charging $14 extra for each share. Shares are 2,000. So 28,000 additional paid in capital, which is paid in capital in excess of stated value, common stock. The last thing is declared a cash dividend on outstanding share of $1.2 per share. So opening balance was 95,000. Then we issued on April 1st 25,000 shares. It becomes 120,000 shares. Then on December 1st, we issued 2,000 more shares. So the outstanding balance is 122,000 shares. $1.2 per share. So our answer is 146,400. So cash dividend gets debit, dividend payable gets credit. Then part B, they are saying how are dividends and dividend payable reported in the financial statements prepared at December 31st. Now, if you see, we have two times dividend transactions, June 15 and December 15. June 15 was already paid, so there was no dividend payable. But December 15 dividend is still payable at December 31st. Okay, so we will have only this as the dividend payable. So in the retained earnings statement, the dividends will be deducted. Firstly, we know that we have two cash dividend. So this cash dividend, which is 120,000, and this cash dividend, which is 146,400, together they are 246,000. 266,400. So this will reduce the retained earnings, and in the balance sheet only this dividend payable will come because this dividend payable is already paid. So only payable is this 146,000, and in the current liability section it will appear. I hope it is clear. Let's move on to exercise number 14-2. Goodson Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. At December 31st, the company declared the following cash dividend. In 2016, the year of organization, December 31st, company has declared $5,000 cash dividend. December 31st, 2017, it declared 12,000 cash dividend. And in December 31st, 2018, it declared 28,000 cash dividend. So 3 years consecutive cash dividend information is with us. What we are supposed to do, part number A, show the allocation of dividend to each class of stock. How many classes of stock we have? We have preferred stock and common stock. Assuming that preferred stock dividend is 6%, so we get the dividend percentage for the preferred stock, and it's non-cumulative. We know that, but it's non-cumulative. If 1 year it is not paid, second year we ignore it, we don't charge it. Okay, so what they want us to do, show the allocation, not the journal entry. They want us to show the allocation. So firstly, let's calculate how much dividend preferred stock want. It's 6%. So 6% is how many preferred stock dividend we have? We have 2,000 shares. Okay. So how we are going to do this? If you see, I did this calculation for you over here. 6% of the par value is going to be $3 per share. And how many shares we have? 2,000 shares. So $6,000 is going to be dividend for the preferred stock. Now let's make a table 2016, 17 and 18. How much dividends are declared? In 2016, 5,000 is declared. It's given in the question. 2017, 12,000 and 2018, 28,000. How much will be allocated to the preferred stock? Preferred stock wants a dividend of 6,000, but we have only 5,000. We will give all to the preferred stock and nothing will be left for the common stock. In 2017, total dividend declared is 12,000. How much preferred stock wants? 6,000. We will give it. Last year dividend which is not paid to the preferred stock, we will not consider it because it's non-cumulative. And after paying dividend to the preferred stock, how much is for common stock? So that is 6,000. In 2018, dividend declared is 28,000. How much preferred stock wants? 6,000. So how much is for common stock? That is 22,000. Second, which is part B, it says that shows the allocation of the dividend to each class of stock, assuming that preferred stock dividend is 7% and it's cumulative. Okay, so let's do this. Firstly, 7% of 50 is 3.5. Per share, how many shares? 2,000 shares of preferred stock, so $7,000 cumulative. Okay. 2016 declared dividend 5,000. 2017 dividend declared is 12,000. 2018 dividend declared is 28,000. In the first year, which is 2016, preferred stock won 7,000, but we have the dividend of 5,000 only, so all will be given to the preferred stock. Is there any arrears? Yes. They wanted 7,000 but we paid them 5,000, so the arrears are 2,000, which will be considered in the next year because it's cumulative. In the first year, nothing is left for the common stock. In 2017, the preferred stock dividend is 7,000 for 2017, but there are arrears of 2,000 from the previous year, so together it is 9,000. So out of 12,000, 9,000 will be taken by preferred stock, remaining, which is 3,000, will be given to the common stock. Is there any arrear in 2017? No, because all the dividend is paid. 2018, 7,000 dividend is for 2018 for the preferred stock. There was no arrears from the previous year, so rest will be given to the common stockholders. Part number C says that journalize the declaration. Declaration means declaration date of the cash dividend at December 31st, 2018. We have 3 years now, so they want for 2018 under Part B, in which we have cumulative. We know that allocation does not have an effect on the journal entry. Whatever dividend is declared, that will be recorded. So cash dividend gets debit, dividend payable gets credit, 28,000, 28,000. Let's move on towards the next question, which is exercise number 14-3. On January 1st, 2017, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of 750,000. The company issued 40,000 shares of common stock at par on July 1st and earned a net income of 400,000. They want us to journalize the declaration of 15% stock dividend on December 10, 2017. Two independent situations we are giving us. Firstly, it's stock dividend, right? So percentage is 15. So it's less than 20 to 25%. So we have small stock dividend, and small stock dividend is recorded at market value. In this opening paragraph, we don't have market value, but if you read part A and part B, it's given. So let's solve under part A first. We need to journalize the declaration journal entry only. And the par value, they say consider $10 and the market price is $18. It's a stock dividend. The stock dividend will get debit, common stock will get credit, and paid in capital in excess of par, common stock will get credit. Stock dividend will be recorded at the market value, but firstly we need to check how many new shares will be issued, right? If you see here in part 1, they are saying the par value is $10. We don't have the clear information of opening balance of the common stock, but they gave us full value of the common stock. We know common stock is equal to shares or outstanding shares multiplied by par value. If we need shares, so we will divide common stock with the par value, we will get number of shares, right? Common stock is 1 million, opening balance. Par value in part A is $10. So 100,000 is the opening balance of the common stock. But do not forget that the company issued 40,000 additional shares on July 1st. So they are also eligible for the stock dividend. So how many total shares we have? We have 140,000 shares. Now 15% stock dividend is issued. So let's calculate how much is 15%. 140,000 multiplied by 15%. So you will get your new number of shares, that is 21,000 new shares will be issued at stock dividend. So let's record our journal entry. Stock dividend gets added 21,000 shares multiplied by market value because it's a small stock dividend, that's 18. So we will get 378,000. Its declaration date. So common stock dividend distributable gets credit 21,000 shares. Par value is 10, so 210,000. Rest will go where? Rest will go in excess account. How much is excess? 18 was the dividend value, 10 was the par value, so 8 is excess per share. So 8 multiplied by 21,000, that is 168,000. All these calculations which I did, they are more formally done here. Let's do part B. Part B says that par value is $5 and the market price is $20. It's still stock, small stock dividend. So let's solve this over here. Firstly, let's calculate the number of shares in the start of the year. So 1 million was the capital stock. Par value is $5. So 200,000 shares are there. I already explained this formula to you in part 1. July 1st, 40,000 new shares were issued. Total number of shares are 240,000. 15% stock dividend on 214,000 is 36,000 shares. They will be recorded at market value, and in part B, market value is 20. So stock dividend gets debited 36,000 multiplied by 20, that is 720,000. Common stock dividend distributable gets credit into par value, that was 5. The number of shares are 36, so 180,000. Remaining will go there, where that is paid back in excess of par. Common stock 15 is excess because 20 is stock dividend, 5 is the par value. Difference is 15 for 36,000 shares. That is 540,000. So this is how you record this journal entry. Let's move on towards next question, which is exercise number 14-8. On January 1st, 2017, Addy Corporation had retained earnings of 650,000. During the year, Addy has following selected transaction. It declared a cash dividend of 120,000, corrected overstatement of net income because of the inventory error 40,000. So how do you correct overstatement of net income? You minus it. How do you correct understatement of net income? You add it, right? So income was overstated in the previous year. We're going to deduct it now. The company has earned a net income this year 350,000, and it also declared a stock dividend of 90,000. So we have cash dividend and stock dividend, so we will be putting them in the internal column. We need to prepare the retained earnings statement for the year. So let's do this. Eddy Corporation retained earnings statement for the year ended December 31st, 2017. Balance on January 1st as reported. It's given over here 650,000. Then correction of overstatement of 2016 net income. So we are going to deduct it because it was overstated. So the adjusted balance is 610,000. Add the net income. So that is 350,000. It's given over here, right? And then less dividends, both dividend, cash dividend. Just drag it here under the cash dividend and stock dividend. Cash dividend was 120,000, stock dividend was 90,000. So together they are 210,000. So we are going to get the ending balance of 750,000. Let's move on towards the next question, which is exercise number 14-9. New Life Company reported retained earning at December 31st, 2016 of 110,000. Newland had 200,000 shares of common stock outstanding at the beginning of 2017. The following transactions occurred during 2017. An error was discovered in 2015. Depreciation expense was recorded at 70,000, but the correct amount was 50,000. The depreciation expense was overstated. Um, and when it was overstated, the net income was understated. A cash dividend of $0.5 per share was declared and paid. A 5% stock dividend was declared and distributed when the market price was 15 per share. Net income was 285,000. They want you to prepare the retained earnings statement. The difference in this question and the previous question is that in the previous question they gave us the amount of stock dividend, but here they want us to calculate it. Now we know that 5% stock is a small stock dividend, so it should be recorded at the market value, which is 15, right? So let's do these calculations and prepare our retained earnings statement. Firstly, opening balance of retained earning. We need to prepare the retained earning statement for 2017. We have ending balance of 2016, which will become the opening balance for 2017. Okay, so what is the ending balance of 2016? 310,000. So we'll write here balance January 1st as reported 310,000. Then we need to do the correction of income, right? So if you see here, 2015 depreciation expense was recorded as 70,000. So the expense was recorded at 70,000, but actual expense was 50,000. Expense was recorded more. It means that expense was overstated. When we have overstated expense, net income gets less, understated, right? If you want to correct understated net income, you have to add the factor. How much difference? 20,000, it was recorded more. So now let's add it back because net income was less with 20,000. So I'm going to add correction for the understatement of 2015 net income, that is 20,000. So balance as adjusted becomes 330,000. We have net income of 285,000, so that comes up 615,000. Cash dividend was 0.5 per share. So also cash dividend full amount is not given. We have to calculate. So let's see how many shares we have. Shares are 200,000. So zero point 0.5 of 200,000, 200,000 multiplied by 0.5, that is 100,000, right? So cash dividend is 100,000. Stock dividend is 5%. So our outstanding share was 200,000 and the 5% of it, 200,000 multiplied by 5%, how many new shares come? 5% means 0.05. So the new shares will be 10,000 new shares. The market value is 15. So how much stock dividend will be there? That will be 150,000. I did the calculation here as well. Stock dividend is 150,000. Add these two, that is 250,000. So when we deduct this dividend out of our adjusted income, adjusted retained earning, we get 365,000 as the ending balance of retained earnings. So you can have both situation, either per share dividends or you might have the full amounts of the dividends. The thing is you need to calculate the dividend and prepare the retained earnings statement. Next is exercise. Okay, let's solve our next question, which is exercise number 14-2. Following information is available for Norman Corporation for the year ended December 31st, 2017. We have sales revenue, we have other revenues and gains, we have operating expenses, we also have cost of goods sold, other expenses and losses. And preferred stock dividend is 30,000. The company tax rate was 30% and it has 50,000 shares outstanding during the entire year. What we are supposed to do, we need to calculate earning per share. We all know the formula of earning per share, that is net income minus preferred stock dividend divided by weighted average outstanding shares, right? Um, we have all the information of income statement, but we do not have net income. We have to calculate it by preparing an income statement. Starting with sales, now I'm doing this rough work for you so that you can have your net income. Starting with sales of 700,000, then from the sales we deduct cost of goods sold. So that is, if you see, that is 465,000. So we get our gross profit. So let's quickly do this. 700,000 minus 465,000, that is 235,000. Then we deduct all the operating expenses. So if you see the question, operating expenses are given as 110,000. So when you deduct this, you get 125,000 as operating profit. Then from this operating profit, you add other income and gains. So I'm just writing it as other gains due to less space, and also I'm making an informal income statements. If you see here, other income, other revenues and gains are given as 92,000, and I have to deduct uh, losses or other expenses. They're also given 32,000. So if I do this, 125,000 plus 92,000 minus 32,000, I get my income before tax as 185,000. Now I need tax expense. For tax expense, they gave me a percentage of 30%, 30% of income. So when I take 30% of it, when I take 30% of it, that is 500, sorry, that is 55,500. And if I deduct this tax expense from my income before tax, I get my net income of 129,500. Now this net income I'll put in the formula. So net income minus preferred dividend divided by outstanding shares. All this information is given in the question. So my earning per share comes up $1.99. Let's do the next question. I'm just removing this part. In 2017, Pennington Corporation had net sales of 600,000 and the cost of goods sold of 360,000. Operating expenses were 153,000. Interest expense was 7,500. The corporation tax rate is 30%. Um, Okay, let's. It's almost the same information which is given on the above question, but let's do it here. Interest expense was 7,500. The corporation tax rate is 30%. The corporation declared preferred dividend of $15,000 in 2017, and its average common stockholders' equity during the year was 200,000. Requirement A, prepare the income statement. Requirement B, calculate the return on common stockholders' equity. Remember, this answer is in percentage for part B. So let's calculate the income statement. Firstly, we are putting the net sales. They are given. Deduct the cost of goods sold and get your first level of profit. That is 240,000. Then you deduct operating expenses out of it. That is 87,000. Then you deduct interest expense because that's also there. So you get income before income tax. Income tax is 30%, so that is 23,850. Finally, you get your net income. Once you get your net income, you can calculate return on common stockholders' equity. So firstly, we need to know what is the net income available to the common stockholders. So net income minus the preferred dividend will give us the net income that is available to the common stockholder. Net income is 55,650, but the preferred stock dividend is 15,000 and our outstanding average shares are 200,000 divided by 200,000. So you will get 0.203. Answer is in percentage, so multiply it with 100. You get an answer of 20.3%. So this is it about the discussion of the calculation for chapter number 14. Hopefully you understand them. And I just suggest to make a previous question income statement in the same format like we did here in in question number 14 dash 2, prepare the income statement in the same format like we did in 14 dash 3 so that the things are more clear to you. Once you get your net income, then you calculate earning per share. Okay. If there are some confusions, just let me know by writing the comments in the comment section, and I will come back with the recording of chapter number 15, which is about long term liabilities, very soon. If you want to listen to that recording, please subscribe to the channel so that you can get a notification when I upload the new videos for you. Take care, everyone. Bye.